Hi, I'm Derek Bisson, and in today's video, we're going to be talking about asset-based home loans. These are home loans designed for applicants who want to leverage the strength of their wealth portfolio instead of necessarily using, or perhaps in addition to using, the income from their tax returns. In this video, we're going to cover the following topics. What is an asset-based loan? The 4 different types of asset-based loans, and features and benefits. Let's get started. So if you're living off of your savings, I'm sure you know how frustrating it can be to apply for a mortgage with your local bank or credit union. I mean, you know that you have more than enough savings to cover the cost of the monthly payments, but the bank doesn't seem to see it that way, right? First of all, you're not alone. This sort of loan scenario is more common than you think, and it's because the traditional home loan that you come to know over the years was really never designed with your type of income in mind. It was designed mostly for wage earners and for self-employed business owners, but certainly not for those who live off of their savings. And when you understand it in this perspective, it's actually easy to see why it can be so frustrating and why the banks have you jump through so many hoops, all for just to qualify for a mortgage. This is why we have asset-based lending programs. With an asset-based mortgage, the lender is free to use the strength of your liquid assets as a means to determine your eligibility to make the new monthly payments on the new mortgage over time, either in conjunction with or exclusive from the income that's being reported on your income tax returns. It gives you the freedom to buy a home responsibly, leveraging the money in a smart way like you've always done, without having to waste a whole bunch of capital on buying a house all cash. And the best part is that we don't require that you move your money around. So if you like your financial advisor or your banking or investment firm, then you can keep those relationships intact. What makes an income-based loan program different is that we apply an income formula to your liquid asset portfolio to see how long you can reasonably afford to make the monthly payments. This is a process that's often referred to as asset depletion, since you may be depleting your assets over time. It's also referred to as amortization, or amortizing your assets over time, or sometimes referred to as annuitization. Since we're using our own income evaluation of your assets, it means that we don't necessarily have to ask you to establish a structured monthly withdrawal schedule when you're accustomed to just taking out the type of money that you need as you need it. We're about to cover 4 different versions of this program. However, the one thing that they all have in common is that they all use liquid asset accounts for the calculation. And by liquid accounts, we include things like checking accounts, savings, money markets, stocks, bonds, IRAs, 401ks, etc. Money that, if you needed to in a pinch, that you could liquidate quickly to make your new monthly mortgage payments. And in the interest of full transparency, this loan program is not designed for those whose wealth is centered around real estate holdings or cryptocurrency. Again, only liquid asset portfolios can count. And to start us off, we're going to talk about conventional loans. Yes, conventional loans do have an asset-based approach to qualify, but there are plenty of restrictions as well. The asset-based approach we're describing here is known as asset depletion, since the lender is expecting you to deplete or spend your money over time to make the new payments. There are 2 main ways to calculate asset depletion income. One is the Fannie Mae calculation, and the other one is the Freddie Mac calculation. Let's start with Fannie Mae. Fannie Mae conventional loans have the easiest formula to understand, but it also yields the smallest amount of income on average. Basically, you take the total qualifying liquid assets after closing and then divide by 360 months, and that becomes the new monthly income for your loan. So let's say after closing, you have $1 million in liquid assets left over after your down payment and closing costs. So that, under this formula, works out to be about $2,777 a month, which in today's market is not really a lot of money. And now let's look at Freddie Mac. Freddie Mac conventional loans allow the lender to take the total qualifying liquid assets and divide by 240 months, not 360. In theory, this might generate over 30% more income, but the catch here is that Freddie Mac applies more restrictions to the type of asset accounts that are usable, and then of course what percentage of those funds in those accounts they will allow the lender to count before dividing by 240. We've seen scenarios where Freddie Mac required us to reduce the total amount of a borrower's assets by over 50% before we were allowed to divide by 240, leaving the borrower with practically no money left to qualify. Obviously, this isn't the case every time, but it can happen. So be sure to ask your loan originator, one who's experienced with asset depletion income, to give you the pros and cons before you get started. As you can see, both conventional approaches seem to be pretty restrictive on the amount of the assets that can be used for income purposes, for qualification. And we find that only the extremely well-qualified applicants can meet this income threshold. And if they're not super well qualified, well, this is when lenders begin asking the applicant to set up and begin executing a structured monthly withdrawal from their assets, not because they wanted to, all just because they needed to qualify for a mortgage. And speaking of limitations, conventional loans are also widely known for the maximum loan amount limit that they apply in any given area on a per year basis. Any loan size above this limit then becomes something called a jumbo loan, where the loan restrictions get even more restrictive, and it's almost virtually impossible for most banks to offer asset-based lending. Next up is our Private Client Portfolio Program. This is our personalized lending solution designed for well-qualified applicants. It offers our clients access to not only extremely competitive pricing, but just as importantly, it offers a level of flexibility not found with either conventional or jumbo loans. One of these benefits is our proprietary asset-based income calculation model, which generates significantly more income, often about 30 to 50% more income than a conventional loan. And best of all, without all the loan size restrictions that we talked about earlier. For this loan program, the minimum down payment is 20%, and we'll lend anywhere from $100,000 up to $20 million. One of the unique things about this program is that we do not use your credit score to determine your interest rate or loan approval. Instead, we perform our own evaluation of your credit and finances to make a lending decision. It's really a great program, and it's my go-to program for high net worth clients who need an asset-based lending approach with competitive pricing and less hassle and restrictions. I'll include a link in the description so you can learn more. The next two programs are part of our Flex Mortgage non-qualifying asset-based lending programs. The first is our Flex Mortgage with asset-based income. Under this program, we take the total qualifying liquid assets and then divide by only 84 months. This generates the most monthly qualifying income for all of our programs. For instance, if you had $1 million left over after closing, we would generate $11,904 in monthly income versus, say, the conventional approach, which would only give you $2,700 or perhaps up to $4,100 in income. And that is a significant difference. The minimum down payment for this program is 10% of the purchase price and requires a minimum credit score for the primary wage earner of 660 or higher. We do accept credit scores as low as 620 under this program, but it comes with higher down payment requirements, such as 20% or 30%. So be sure to ask your loan originator for those details. This program is also known to be very flexible with recent major credit challenges, such as a bankruptcy, foreclosure, short sale, etc. And then finally, it's our Flex Mortgage with asset matching. Asset matching offers you the absolute easiest way to qualify using liquid assets. Basically, if after closing, you have liquid assets equal to or greater than the new loan amount, then the loan automatically meets the income qualification standard. For instance, if you start with a total liquid asset portfolio of $1.5 million and buy a home for $1.2 million with a 20% down payment, and then finance the other 80% or $960,000, then the loan would automatically be approved from an income standpoint because you would have the liquid assets greater than the loan amount of $960,000 left over after closing. And there you have it. We hope you find this information helpful. If you'd like more information about asset-based lending, be sure to check out our asset-based lending resource page. I'll include a link in the description below so you can check that out. And of course, if you're looking to purchase, refinance, or get pre-approved to purchase a home anywhere in the state of Florida, we would love the opportunity to be your lender. Thanks again for watching. I'm Derek Bisson, and this is Unconventional Lending.